What if I told you the single most dangerous stock in the entire market right now is one of the 7 most beloved? I just ran all 7 of the magnificent stocks through my 10-year valuation model, and the results were a complete shock. I waited until every calculation was done because I didn't want to believe what I was seeing. 4 of them look like they'll seriously underperform. 2 might just match the market. And only one, a single solitary name, showed the clear potential to actually beat it over the next decade. And I guarantee you, it's not the one you're thinking of. But the scariest part? One of these titans, based purely on the math, appears to be a financial trap. It's so wildly overpriced that I believe buying it today could lock in a permanent loss. 10 years from now, I think it trades for less. And no, for the last time, it's not NVIDIA. This isn't just a ranking. This is your blueprint. I'm going to show you the exact framework I used, the same one you can use to analyze any company. This is about the most important rule in finance, one that gets ignored every single day. A spectacular story is a terrible investment if you pay a ridiculous price. Let's start with the biggest problem. The stock I think you should be terrified of owning right now. This is the one my model screams, sell. It's Tesla. We need to call it what it is. Forget robots, forget AI, forget software. Over 90% of its revenue comes from building and selling cars. Therefore, it is a car company. A brilliant, innovative car company, but a car company nonetheless. And as we're speaking, it's hitting all-time highs with a valuation approaching $2 trillion. For an automaker, let that number just hang in the air for a second. The software narrative? Now, the numbers. Its price-to-sales ratio is 17. The average major automaker? Between 0.5 and 1. On that metric alone, it's priced at 17 to 34 times its peers. Its profit margins, once the envy of the industry, are now compressing. Just a few years ago, the biggest bulls projected 5 to 10 million annual car sales by now. The reality? They're struggling to move 1.8 million. This is the core of the problem. When you pay a premium for perfection, any stumble is catastrophic. A shift in consumer sentiment, a rise in competition, a change in the CEO's public perception, any of these can derail the story. And you, the investor, are left holding a valuation built on dreams. So what does my 10-year model say? I gave Tesla every benefit of the doubt. Aggressive revenue growth, recovering profit margins, generous valuation multiples a decade from now. I hit analyze, my middle-of-the-road most likely scenario, a price target of about $185. With the stock over $400, that implies a negative annual return. Even my wildly optimistic best-case scenario only showed a 7% yearly gain. For a company with this much execution risk, that's a terrible bet. You're not paying for a business. You're paying for a prophecy. And prophecies are fragile. I've owned their cars. I admire the engineering. This isn't personal. This is mathematical. Most investors are destroyed by falling in love with the story and ignoring the price tag. Valuation isn't everything. It's the only thing that protects you from a great story. We must eliminate the obvious losers first, where the price has vaporized any rational connection to value. All right, let's climb the ladder. Who's next? Apple, the fortress. A $4 trillion monument to quality and ecosystem lock-in. They generate over $100 billion in cash annually. Their shift to high-margin subscriptions is masterful. Their 8 pillars business health check is almost perfect, all green flags. You are buying one of the greatest machines ever built, but you are also paying for it. 36 times earnings, 41 times free cash flow. You are paying a king's ransom for royalty. My model, assuming steady but slowing growth from this gargantuan base, spits out a middle price target near $190. At today's price, that pencils out to roughly a 4% annualized return, basically matching the market. A wonderful company, but at this altitude, the law of large numbers is a powerful gravity. The best thing Apple can do for shareholders now is buy back its own stock. But it needs a cheaper price to do that effectively. Now, the king of the moment. The heart of the AI revolution. NVIDIA. The numbers are, without hyperbole, historic. Free cash flow has gone parabolic. Profit margins are soaring above 50%. Its business quality scorecard is pristine. This is a company executing at a level we rarely witness. And yet, the question is never, is this a great company? It is always, did I pay a great price? Analysts project earnings to triple in 5 years. Do the quick math. If they hit $9 per share in earnings, and you apply a generous 30x PE ratio, you get a $270 stock. It's at $170 today. That's a solid gain, but it requires 5 years of everything going perfectly, with no slowdown in the AI boom, and the market maintaining a frothy mood. In my 10-year model, even with aggressive assumptions for a decelerating growth story, MY middle price target came to $155. The potential returns are a wide band, from slightly negative to very positive. This isn't a clear buy or sell. It's a statement of fact. At this price, you are making a binary bet on the uninterrupted, explosive growth of AI for a decade. You are betting against cyclicality, competition, and saturation. It might work. But is that investing, or is it speculating? Let's look at a different kind of giant. Microsoft, the $3.5 trillion diversified empire. It's not just riding the AI wave. It's building the entire ocean with Azure. Its cash flow is immense, though heavily reinvested into capital expenditures for the future. Its business health is stellar. My analysis here used more reasonable, sustained growth assumptions. The result? A middle price target of $435. With the stock around $480, that suggests a potential annual return just under 8%. Better, but still not a screaming bargain. The key difference from NVIDIA? If Microsoft's growth is a bit slower than hoped, it's a resilient behemoth. If NVIDIA's growth stutters, the fall could be violent. In investing, the downside protection is often more important than the upside dream. This brings us to the everything company. Amazon. They're in a perpetual investment phase. So current cash flow looks weak, but look underneath. Net income is exploding. Their secret weapon is a 50% gross margin. As revenue grows, profits can leverage up incredibly. They are embedded in the global economy's central nervous system. My model, giving them credit for future profit expansion, yields a fascinating result. A middle price target of almost exactly today's stock price. It implies a return right around the market's historical average. Not a discount, but perhaps a fair price for a dominant, future-proof franchise. For the first time, we're looking at a potential hold rather than a caution signal. Now, what about the search and advertising colossus? Google, Alphabet. A cash machine with an 80% plus gross margin. It's like a toll booth on the digital universe. Its business health is nearly perfect. The narrative fear is AI disrupting search, but we've heard Google killer stories for 20 years. My conservative valuation model placed its fair value right at $300. The stock price, as we record, $297. Another example of a phenomenal business trading at, but not significantly above, its calculated intrinsic value. No margin of safety, but no obvious insanity either. This leads us to the final name. And this is the one that truly surprised me. Meta, my old nemesis. The stock I bought aggressively when everyone hated it, down below $100. It's now a $1.7 trillion giant. But look past the metaverse headlines. Look at the core, 82% gross margins. Nearly 4 billion people use its apps every month. That's half of humanity. The network effect is atomic grade strong. Its business health scorecard is flawless. When I ran my model, Using what I thought were cautious assumptions, the numbers jumped off the screen. My middle price target came out to $815. With the stock significantly lower, the implied annualized return was over 11%. Even my pessimistic low-case scenario showed a positive return. Of all 7, Meta was the only one where my most probable assumptions pointed to a clear, market-beating opportunity. It combines a supreme business model, an unassailable moat, and a price that doesn't assume divine perfection. So there's your breakdown. The Magnificent 7, stripped of hype and run through a valuation model. 1 looks dangerously overvalued, Tesla. 4 look fairly valued to rich, offering market matching or lower returns, Apple, NVIDIA, Microsoft, Google. 1 looks fairly valued for a solid hold, Amazon. And 1, against all my expectations, emerged with the clearest value proposition, Meta. The lesson is never about the story alone. It's about the price you pay for that story. The best investment isn't the hottest story. It's the best price for a great story. If you want to learn this framework and stop guessing, that's what we do here on Winds of Thought. We replace emotion with analysis and hype with process. If this breakdown helped you see the market differently, do me a huge favor. Like this video. It tells the algorithm to share this with other investors who need to hear it. And tell me in the comments, which of these 7 do you think is the most misunderstood right now? But what if I told you I've already found 7 other stocks outside the Magnificent 7 that my model says have even stronger return potential over the next decade? I analyzed them side by side. The results shocked me. That's the next video. Make sure you're subscribed so you don't miss it.